Hey guys, it's James, and today I was going to compare QYLD versus DIVO on my fund versus fund calculator and take a look at some of their stats on their website pages, a little bit of data on Seeking Alpha, go to Portfolio Visualizer, and look at the historical comparison of QYLD versus DIVO, and then come back to my spreadsheet and then see what a portfolio of QYLD versus a portfolio of DIVO would look like with the numbers that we find from Seeking Alpha and their fund website pages, and what type of income we can expect to receive from QYLD versus DIVO. And then we'll take a look at what it looks like without reinvesting dividends and with reinvesting dividends with these two funds. So over on QYLD's website page, the reasons to consider QYLD: it seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. QYLD has made monthly distributions 8 years running. So that's a big point to QYLD, is monthly payments. QYLD writes call options on the NASDAQ 100 index, saving investors the time and potential expense of doing so individually. Their inception date was about 8 years and 3 months ago, so 8.25. Total expense ratio is 0.60%. We're going to use this later, and we'll take this into account as well. The inception date, 13.82%, 12-month trailing yield. The fund objective is to provide investment results that correspond generally to the price and yield performance before fees and expenses of the CBOE NASDAQ 100 Buy Right Index. Over on Amplify's website page for DIVO, it's high quality equity income potential with a proven approach. We'll also take a look at the number of holdings in DIVO versus QYLD and see if there's any overlap between them, but DIVO only holds about 28 holdings as stated here on the website. We're also going to take this inception date and use this to calculate our CAGR number. So we're looking at a time period of about 5 years and 3 months, so 5.25. We'll need this number here, 0.55% expense ratio. Put that into our calculator. So there are reasons to invest in DIVO. It's comprised of high quality dividend oriented stocks along with covered calls on individual stocks. Allows the portfolio manager to identify opportunities and risks and act on those decisions in real time. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. Over on ETFRC, we're going to look at the overlapping between QYLD and DIVO. There's only 4 holdings that are overlapping each other, and 3.9% of QYLD's 100 holdings are in DIVO, and 16% of DIVO's 25 holdings are in QYLD, with a total weighted percent overlap of 12%. So these funds don't really overlap themselves very well. So this is what we're looking at with their weighted overlap, 12% in common. Coming over to QYLD's page on Seeking Alpha, this is their advanced market price data. So at the fund inception date of December 2013, if you recall from their website, their starting price was about $25 per share. So if you drew, what we're trying to find here is a straight line from the starting value 8 years and 3 months later all the way to here. Now obviously if you entered here and exited here, you would have had a positive appreciation in your fund portfolio value plus the dividends. Same thing if you entered here and exited here, or entered here and exited here. But some people are not as lucky to be able to time the market and get out ahead. So we're going to go ahead and use the CAGR number and calculate it from the fund start date all the way to today to try to get the most accurate representation. If you know how to time the market, go for it. It looks like it might start coming back up, so you might want to invest right here, but who knows? It's all up to you. So with the starting value being $25 and the time period being 8 years and 3 months, we'll use that to calculate our CAGR number. Same thing for DIVO. The fund starting price December of 2016 was $25, and you can see it's pretty much been all uphill even to today. And in the first quarter of 2022, we have not seen as much of a drop as we have had with QYLD, with the ending value of being market price currently being $37.74 So we'll use these figures right here to try to figure out a straight line CAGR number over the course of 5 years and 3 months. We'll go ahead and do that right now. This is another tab on my spreadsheet. So all we need to do is input the yellow number or the yellow figures right here. $25 starting value for QYLD. Time period is 8 years and 3 months, so 8.25. Ending value is 20.87 for a total cumulative annual growth rate over the course of 8 years at a negative 2.16%. For DIVO, the starting value is $25. The total time period is 5 years and 3 months, so 5.25. The ending value is $37.74. And we're looking at a CAGR of 8.16. So we'll use these numbers to determine the future value of our portfolios. I do want to come over to QYLD's dividend history and dividend yield page on Seeking Alpha and just show you something here real quick. So the current number that we're going to put into our calculator is about 13 to 14% for a trailing 12-month yield, but it seems like a more consistent number for their dividend payout is closer to an 11 to 12%, and it jumped up here at the end of last year, up to closer to 13%. So you see they were paying a pretty consistent 20 to 23 cents per month for their dividend payout, and it jumped up to 50 cents per month. So that is increasing the dividend yield from about 11% to about 13 to 14%. So we might play around with that number with QYLD on our spreadsheet. So take that into consideration. And this was only paid out at the end of 2021. At the end of 2020, we did not see anything like that. And at the end of 2019, we didn't see anything like that either. Taking a look at DIVO's 12-month trailing yield, it's been pretty consistent over the past year at about 4.8. So we will use that number. And just a quick historical comparison. If we had a $10,000 initial investment comparing QYLD versus DIVO, investing this $10,000 at the fund inception date of DIVO and QYLD at the same time with reinvesting dividends, we'll take a look at what it looked like with reinvesting dividends and without reinvesting dividends. Coming down on the graph, if you invested $10,000 as soon as you could have in both funds, which would have been the fund inception date of DIVO, December 2016, you would have had a 8.9% CAGR with dividends reinvested with QYLD and a 13.5% CAGR with DIVO with dividends reinvested. So this is what they would have looked like at the end of February. If you didn't want to reinvest dividends, you can see that, again, DIVO would outperform QYLD in this time period. QYLD's CAGR would have been a negative 2%, very similar to what we calculated for our calculation for our CAGR number. And then DIVO would have been a 7.5% without dividends reinvested in this time period. Coming down to what the portfolio income would have looked like, the most recent full year QYLD would have paid you $1,200 and Amplify or DIVO would have paid you $674. Coming back over to the calculator, again, we're going to start with that 13.8% figure for QYLD in their dividend yield, and we're going to use that 4.8% dividend yield for DIVO. We're going to start with the $0 monthly addition, negative 2% for QYLD annual growth rate, and an 8% for DIVO. With dividends reinvested, this is what your portfolio values would look like. It looks like DIVO would outperform. So if you are going to reinvest dividends, it looks like DIVO is the way to go over QYLD. And then if we were to drop this to the more conservative 11% 12-month trailing yield dividend number, this is what your portfolios would look like. DIVO would further separate itself from QYLD over the course of 10 years. You would have 33,000 in DIVO and 21,000 in QYLD. Let's say QYLD is in a slump right now and you did have a little bit of an increase and you were able to hold on to QYLD for the next year or two and you did see an increase. Let's see what it would look like if you had a 1% increase over the course of the next few years. Then again, we wouldn't be able to go all the way out to 10 years. All out staying the same with DIVO, keeping the dividend yield at 11%. If you had a slight increase in QYLD, this is what you would be looking like. DIVO would still slightly outperform QYLD. Now, let's take a look at it if you were not to reinvest dividends. Let's go ahead and put it back at that 13.8% figure. QYLD continued to depreciate over time. With a $10,000 investment, your portfolio with QYLD would start to decline. DIVO would continue to increase. Here's what your incomes would look like over time. Your dividend payout or income for QYLD over the course of 10 years would start to get smaller. And with DIVO, obviously a lot less income, but the income would be consistent and growing if these funds would perform like they have in the past few years. Let's go ahead and play around with these numbers a little bit more. Let's say you had a $50,000 investment. You had $50,000 to be able to throw into these funds, and you were putting $500 a month in QYLD, or you were putting $500 a month in DIVO. This is what it would look like over the course of 10 years. When you start adding money into DIVO, it really starts to compound. It would take quite a while for the amount of income to overcome DIVO to overcome QYLD. And just one more scenario, if you had a high value portfolio, if you had $750,000, $750,000 in either fund, this is what you would look like if you let it ride for 10 years. And this is the type of income it would look like over the course of 10 years. And over here, this is the portfolio size you would need for QYLD versus DIVO. If you wanted $10 a month all the way to $5,000 a month, you would need $434,000 in QYLD to achieve $5,000 a month, and you would need $1.25 million in DIVO to achieve $5,000 a month. To achieve $100 all the way up to $100,000 a year, you would need $724,000 of QYLD to achieve this annual dividend number, and $2 million in DIVO to achieve this dividend number. And with that, head down into the comments and let me know what you thought of this comparison. In my personal opinion, I believe DIVO is the more solid fund, even though if you are not reinvesting dividends, you might want to invest in QYLD. But if you are reinvesting dividends, I don't see why you would invest in QYLD over DIVO. So let me know what you think of this analysis. Let me know if there's any other analysis you want me to do. And this spreadsheet is available on my Patreon. And with that, thanks for watching.